Welcome to another MENA market briefing. My name is Timothy France and I'm joined today by fellow oil market analyst Mohammed Yasser. As usual, we'll kick things off with crude oil benchmarks, market structure and global fundamentals. After that, Yasser is going to run us through the buoyant light distillate scene, so stay with us. Let's begin with Brent on the top candlestick chart. Evidently, there has been a loss in momentum for front-month oil futures as the post-outbreak reflation trade appears to have run its course. Price action shows a breakdown in the 9-month bull trend, which began back in November last year and finally came to an end in mid-July, when the market started trading contracts for September delivery. The market is consolidating now in the $65 to $75 price range. Meanwhile, recent commitment of traders data shows that hedge fund managers, or so-called managed money, have trimmed their long positions. This is generally attributed to profit taking and traders exiting the market rather than flipping long to short. That was true across many asset classes in late August as global markets adopted a risk-off tone ahead of the US Federal Reserve meeting and concerns about resurgent Delta variant threats. Turning to benchmark spreads, we see that in the middle chart there, WTI has deepened its discount to Brent through August, suggesting relative softness in the US crude market. Meanwhile, the Brent Dubai EFS in the bottom chart shows the light sweet benchmark has been very strong relative to the medium sour benchmark for Asia. Now, a critical factor in that price dynamic is the seasonal strength for light end refined products, which Yasser will highlight for us shortly. Sticking with the Asian crude for the time being, on the right, we have the time spreads for Dubai crude. The important takeaway here is the steep adjustment we see in August. Yes, markets are still firmly backwardated on Dubai contracts at a range of about 50 cents per month. But the extremity of that backwardation is coming off. So the flattening of that forward curve suggests that the market may be normalizing as supply and demand come back into balance. Now here we have the EIA short-term energy outlook data, which confirms the very same. Now pay attention to the fourth quarter of 2021 forecast data. It shows that the global crude market is now in a transition phase. We're moving from orchestrated supply deficit to relative equilibrium in global supply and demand. And this is expected to remain so until March 2022. Beyond that, however, there is expectation of oversupply, which may concern some OPEC Plus ministers in the future. Now, the August OPEC meeting did not yield any surprises for the market. OPEC Plus will proceed with a planned production increases of around 400,000 barrels per day. Now here we have the seasonality charts, which show total weekly crude exports by region. What we see is that North Africa crude exports are already within their normal range, bearing in mind that Libya is exempt from any action. More importantly, however, we see Middle East exports are only now just returning to their normal range. That trend supports the case for fundamental normalization of global oil markets, and we expect that trend to continue in line with OPEC Plus policy. Now, OPEC Plus is often spoken of in the context of price floors, but then what about price ceilings? This slide shows refinery throughput in key Asian importing countries. China's recovery appears almost complete, with runs at or near pre-pandemic levels. India had recovered prior to the COVID-19 wave, which began again in April and May. By contrast, Japan is operating at 1/3 of its pre-pandemic highs. Now, what this shows is the unevenness of demand recovery, and that is likely to be a persistent theme for global demand in the foreseeable future. But COVID is not the only consideration. At $80 per barrel, price sensitivity and demand elasticity start to factor into the equation. That assertion is supported by reports that Chinese and Indian refiners have been dipping into strategic reserves to preserve their margins. That brings us to refined products. Now, here we have the crack spreads for Dubai crude in Singapore. What is noticeable is the strength in fuel oil cracks through July and August. And theoretically, this should support prices for medium and heavy sour crude grades and bring in the EFS. A major concern is that gas oil cracks remain sluggish, with jet fuel demand still a missing component of the demand recovery. As a result, it's been largely down to gasoline to drive profits for refineries. This in turn is supporting demand for light sweet grades And that in turn is reflected in the strong benchmark spreads we've seen recently. But that may only be temporary, however. And now I'm going to hand over to Yasser, and he's going to be able to explain more.
Thanks, Tim, for the valuable insights. It was really informative. So now I will like to move to light distillates and speak about the market. We are looking at a shift in the light distillates market as we speak, as the peak demand from the summer driving comes to an end. Let's dive a little deeper and start by looking at gasoline market. The gasoline cracks, as you can see from the first chart, has more than doubled from the beginning of the year. The cracks reached a yearly high at that time of peak driving season around July. However, as the summer driving season comes to an end, the cracks started to decline. We see the cracks gain some momentum of lately, mainly due to the impact of Hurricane Ida in the US market. And as the US remains the biggest market for gasoline in the world, it has impacted the other regions accordingly. The cracks have nevertheless dropped as refinery facilities slowly start to come back online in US. As demand was already seen to be dropping in the US, the impact of shutdowns in US Gulf Coast has been kind of limited. Singapore cracks, on the other hand, have faced less volatility in the market compared to the US. Cracks in Singapore remain supported due to the decrease in supply from China and India. However, demand has also been sluggish owing to the spread of COVID cases in many countries in Asia. In the next chart, RBOB prices, which have almost doubled from the start of the year, has now declined as summer driving season approaches to an end. The arbitrage spread between Europe and US similarly saw a drastic decline even after the destruction caused by Hurricane Ida. As we enter winter, the winter spec gasoline will be in demand. However, we expect the arbitrage to be on the lower side. The next chart on the bottom left shows us the gasoline supplied in US, which has improved to pre-pandemic levels, along with increase in COVID cases in US, which has brought about a decline in demand. Gasoline prices in Singapore show a similar trend, with prices improving from the beginning of the year until the end of July, but have come down from its peak and has only improved slightly because of the impact of Hurricane Ida. Gasoline fundamentals in Asia have been volatile on account of multiple restrictions introduced by countries such as Australia, New Zealand, Japan, and Vietnam lately in order to contain the spread of Delta variant. However, improving domestic demand in India, Pakistan, and China have capped those losses somewhat. And decrease in supply from China due to the reduction in quota from products export from the government, which reduced the refined products quota for second half of 2021 at just about 7.5 million metric tons, which is almost 73% lower compared to the second tranche allocation of last year, which was about 25.6 million metric tons. So yeah, this has kept the market short supplied at the time of low demand. The chart on the bottom right shows EBOB forward cracks for the rest of the year, which is in steep backwardation. And later on, it moves to contango in the first month of 2022 as winter starts to retreat, which marks the beginning of the next cycle. Singapore 92 round forward cracks also follow similar trend and remains in backwardation for the rest of the year. Moving on to the next slide. On the left side of the slide here, we can see the US mobility data from retail, commercial, and public transport hub, which has improved from the beginning of the year, reached a peak in July and August, however, has started to decline, say, end of August, as we see increase in cases of COVID-19 Delta variant in the US, along with the summer driving season coming to an end. On the right side, the two charts give you a picture of how the storage has been across the globe for light distillates. Storage at ARA has continuously been falling over the summer due to increase in local demand and increase in exports of gasoline to the US to cater to the US driving season. Light distillate demand in Singapore have also come off from the highs seen in the first quarter of the year, mainly due to decrease in exports from China for the reasons mentioned above. Also, with decrease in exports from India due to strong domestic demand. Moving on to the storage at US in the last 6 weeks, we have seen at least 4 weeks of draws in gasoline inventory. Inventory for the last week ending August 27 increased by 1.29 million barrels, as total gasoline inventory is currently assessed at 227.21 million barrels. Gasoline inventory in the US is expected to further increase in the coming weeks as increase in COVID cases in the country leads to decline in demand, which also coincides with the end of summer driving season. Moving to the next slide, we speak about naphtha market. So naphtha has performed or had performed comparatively better last year during the pandemic times against the other products, as demand for petrochemical as demand from petrochemical industry supported naphtha cracks, as increasing use of single-use plastics and PPE equipment during the pandemic supported naphtha demand. Of late, during summer, naphtha had found demand from gasoline blending pool as well, but with with winter approaching and peak driving season in US and UK almost coming to an end, naphtha fundamentals have started to lose support. The first chart in the left shows the naphtha cracks have performed over the year, and especially during the summer season, demand picked up for gasoline blending purpose, and strong demand from petrochemical sector supported cracks in Asia. The other main reason for strong naphtha cracks has been unseasonal high LPG prices globally. The LPG, which is usually used as an alternative feedstock for naphtha for cracking purpose, has lost its charm due to high prices, which has made petrochemical producers depend on naphtha for cracking purpose instead of LPG, which has in turn supported naphtha demand in Asia. But with cracker maintenance season starting in Asia, along with drop in gasoline blending demand, naphtha cracks have started to weaken of late. Chart on the bottom left shows the prices have increased from the beginning of the year and peaked in July. Prices have, however, come off from the peak as demand started to fall. The East-West spread for naphtha remains low, as European demand for naphtha is supported due to high LPG prices and export to US of gasoline. Naphtha forward swaps for both prices and cracks remain backward dated for rest of the year, as naphtha demand from Asia is expected to be impacted due to the start of cracker maintenance season in Asia. To sum it up, in the coming weeks, we expect gasoline demand to drop as winter approaches, and increase in COVID cases globally impacts gasoline demand as more and more lockdown procedures are put in place to contain the spread of the Delta variant. The decline in gasoline demand has impacted naphtha fundamental as well, but demand from petrochemical sector due to high LPG prices has supported naphtha prices and will continue to provide some support going forward as LPG prices tend to increase during winter season in Asia. And with that, I would like to hand it back to Tim. Thank you.
Thanks very much, Yasser. That was very nicely done. Very comprehensive overview of global markets on the light distillate side of things. So I'm just going to try and wrap things up and bring things back to benchmarks very briefly. Brent crude prices back up for you here. The relative strength of light sweet crude benchmarks may begin to ebb with the boom in summer gasoline demand more or less behind us now, as Yasser just explained for us. We therefore expect to see the Dubai FS narrow, although that will also depend on the appetite for rising Middle East crude exports in Asia. OPEC production policy could show some sensitivity to that going forwards, and I expect that any hint of demand weakness may see them hold off production increases. That is particularly pertinent now, given the fundamentals are expected to remain finely balanced for the next 6 months or so. And as for demand, the recovery appears to be at a very tentative stage, with Delta variant creating concerns and jet fuel demand yet to return in any material sense. As such, we see that the $60 to $75 trading range for Brent futures is probably the most likely scenario for flat price going forwards. So with that, ladies and gentlemen, we'll wrap it up. Thanks for joining us, and we'll catch you again next time.